All right, we are back with Robert Weissenstein, Chief Investment Officer over at Credit Suisse Private Bank. And Robert, let me ask you first of all about the headwinds that you note here. I mean, you seem pretty sanguine about stocks, but we're looking at a huge federal deficit. We're looking at the weakening dollar, obviously, the government's exit strategy. Do you trust them to make the right decisions? And then unemployment, all big issues.
Sure. No, we're not done. And I don't want to have anybody misinterpret what I say as saying everything is just fine. We have things to work through. But by the same token, they're all pretty manageable at this point. There has been a lot of money spent this year, and the deficit absolutely is of some concern. But if you take a look at the debt as a percentage of GDP, we're still below the average of the last 50, 60 years. We're significantly below where the UK is, where Germany is, and a number of other countries. If we continued to spend at this level, it would be an enormous problem. I don't want to dismiss it, but just put it in perspective. The dollar continues to serve its role as a major reserve currency. In the last 10 years, it's gone down from about 70% to 63% of world reserves. That's not really earth-shattering, considering that the reserves themselves have tripled in that time period. So I don't think that we can look at this as a non-issue, but it's somewhat tempered relative to where the concerns are. Jobs are an issue. We've got to get people back to work. That will probably happen as we get this legislative overhang done. Businesses will go to the next level of investment once they know the rules of investing, once they know the tax laws, the regulatory changes. Whether they like the result or not, there just has to be a result, and then can move forward.
Hey, Robert, I want to go back, though, to your outlook on the markets, because I've got a guest, Matt and I've got a guest coming up later on, Jim Bianco, and he really talks about how this is really a liquidity-driven rally, whether it's commodities, whether it's equities, you name it. I mean, you say the numbers and fundamentals really support it. Do you really believe that, considering all the stimulus that's being thrown around? Isn't it just a liquidity move here?
No, I mean, I think that is a part of it. There is a lot of liquidity on the side. Remember, it's only a year ago that everybody was taking all the risk out of their portfolios, and cash levels went to enormous amounts, and they're still pretty high relative to historic levels. That is what you need to have a rally. You can't have markets move forward if there isn't money to pour into them. But there are fundamental reasons for this. Commodity prices are going up because the emerging markets growth continues to be enormous, and it has a long life in front of it. That's not just a 1 month or 2 month phenomena. Stocks are moving ahead. Remember, they came down a tremendous amount. Some of this moved back as a correction or an adjustment against a market that had really vaporized just a year ago. So I think that we have to, again, put some of these moves in perspective. They're certainly large, but we had large moves on the other side as well.
How concerned are you about unemployment? I mean, when we move above, if we move above 10%, could that trigger a double dip in the economy? Is it a very bad scenario?
Well, I mean, we're at a pretty strong level right now, and we got there awfully quickly. So I think that's what has everybody unnerved. What we have to really look at are job losses at this point. Unemployment rate is looking backwards, and it's going to be up at these levels or even slightly higher in the near term, because that's just sort of catching up. But what we really need to look at are the number of jobs being lost per month, and that's been significantly fewer every month. Remember, again, early this year, at the end of last year, we were losing 500,000–600,000 jobs a month. It's down to somewhere around 200,000 or 300,000. Still an enormous number, but significantly less, in a decelerating rate at least.
Robert, back in August, you said there were 3 S's that we had to watch: stimulus, survivors, and spending. Now you talk about the 3 C's to watch, and that's consumers, credit, and China, kind of all really interlinked there.
Absolutely.
What is it specifically we need to watch out for?
Well, I think that as we go forward, and that's for 2010, the roadmap, watch how the consumer spreads out. The U.S. consumer is not going to go back to where he or she was before all of this took place, nor should that happen. But there's a consumer in the rest of the world that will grow, and we'll see how fast that gets traction and how that compensates in terms of growth and where the traction is. Secondly, credit. It's not about a credit crisis now. It's about seeing how credit gets expanded into that middle level of business out there. The large companies can go to market and raise capital in the equity and debt markets, and some of the small businesses that are starting, it just doesn't take as much as it used to get them going. But it's that mid-range we have to see that credit starts to open up there. And then lastly, China, which is obviously a transformational story for the globe. You're always going to hear about whether it's a bubble or not, people questioning it. They thought at one point the Olympics were going to be the end of it. That's a long story in front of us, too, and we just have to see how they sustain that level of growth, which I believe they can.
So what do you like here? And we only have about 10 seconds. What do you like here when investing in the U.S.?
Still going with technology. Go with some of the firms with global reach in the consumer staples area, financials on a select basis, and commodity related.
All right. Hey, Bob, thanks so much for joining us. Robert Weissenstein there from Credit Suisse.